एक्सपीरियंस। तो आज हम सीखेंगे मल्टी बैगर स्टॉक चुनने के फंडामेंटल्स। पहले देखो मार्केट कैपिटलाइजेशन, कम हो तो रिस्क ज्यादा है। फिर बुक वैल्यू और प्राइस टू बुक वैल्यू देखो।
तो देखिए हमारे मल्टी बैगर स्क्रीनर के क्राइटेरिया, सेल्स ग्रोथ 12% से ऊपर, प्रॉफिट ग्रोथ 15%। और देखिए,
Welcome to the Explainer. You know, every single investor dreams of it, finding that one stock that doesn't just grow a little, but multiplies your money. Well, today we're going to break down the systematic hunt for those amazing but elusive multi-bagger stocks.
I mean, that's the million-dollar question, right? How do you actually find companies that have that kind of explosive potential? With thousands of stocks out there, it can feel like you're searching for a needle in a haystack. So today, we're going to build a clear, step-by-step filtering process to find them.
So first things first, what exactly are we hunting for? We're talking about multi-bagger stocks. It's a fantastic term that the legendary investor Peter Lynch came up with. It simply means a stock that gives you a return of more than 100%. You know, you put one bag of money in and you get at least 2 bags back. The real goal, of course, is to find those 5 baggers or even 10 baggers. The whole point here is to find a system that helps us spot them before they take off.
To find these gems, you really need a system. So our process is going to use 3 crucial filters to narrow down the entire universe of stocks. We'll start by screening for quality and growth, then we'll add a layer for financial safety, and we'll finish up with a check on the price tag. And finally, we'll see how you can put all of this together into an automated screener that does all the heavy lifting for you.
Okay, I want you to think of this whole process like a funnel. We're going to start with thousands and thousands of stocks at the top, and with each step, with each filter we apply, we're going to systematically weed out the ones that just don't meet our strict criteria. What we're left with at the end is a small, manageable list of really high potential candidates.
So here are our 3 big tests. First, the quality filter. Is the business itself actually any good? Is it healthy and growing? Second, the safety filter. Is it financially stable, or is it kind of built on a house of cards? And third, the value filter. Even if it's a great, safe company, is it being sold at a price that makes sense? Because remember, a great company at a terrible price is a bad investment.
All right, let's dive into our first and probably broadest filter, quality and growth. Before we even think about the price or how much debt a company has, we have to answer the most fundamental question. Is this a high-quality business that's actually growing? For us, this is a non-negotiable first step.
So, the most basic, vital sign of a healthy, growing business is its sales. I mean, are more people buying what it's selling this year compared to last year? It's that simple. We absolutely have to see consistently increasing yearly sales. A company that isn't growing its top line just can't become a multi-bagger, period. But you know, sales are only one part of the story. A company also has to be profitable, and more importantly, it needs to be efficiently profitable. The best metric to check for this is return on equity, or ROE. This number tells you exactly how good the management team is at using shareholders' money to create more profit.
Now, don't let the formula intimidate you. It's actually pretty simple. You just take the company's net profit and divide it by the total shareholder equity. A consistently high ROE is a huge green flag. It tells you that the management team is absolutely exceptional at turning investment dollars into actual profits.
And the number we're looking for? Our target for ROE is consistently above 15%. Now, that is a high bar for sure, but it's a powerful signal of a really well-managed, superior business. And that is exactly the kind of company we want on our watch list. Another key quality metric is the operating profit margin. Basically, this tells you how much profit the company is making from its main business operations for every single dollar of sales. What we want to see are companies with a healthy margin, and ideally, one that's getting wider over time.
All right, so we've run our first filter for quality and growth. Now we should have a list of pretty good companies. But are they safe? Let's move on to our second filter to check for financial risk. We really want to avoid companies that look great on the surface but could just blow up unexpectedly.
And the first safety check we're going to run is the debt-to-equity ratio. This is a classic, and for good reason. It tells you exactly how much a company relies on borrowing money to run its business. A company with huge debts is just riskier, plain and simple.
The math here is really straightforward. You just divide a company's total liabilities, everything it owes, by its shareholder equity, what it owns. It's a direct comparison, and for our purposes, a lower number is always better.
The specific rule we're going to use for this filter is a debt-to-equity ratio of less than 1. This simple rule makes sure that the company is funding itself more with its own capital than with borrowed money, which makes it a much safer bet for us. Okay, here is a massive risk factor that so many investors miss. It's called promoter pledging. This is when the founders of the company use their own shares as collateral to get personal loans. This is a huge red flag. Why? Because if they can't repay that loan, the bank can just dump all of those shares on the open market, which can instantly crash the stock price. We are looking for companies with zero pledging or, at the very least, under 8%.
So, we've now filtered for high-quality, financially safe companies. Great! But we're not done. There is one final, absolutely crucial step: applying the price filter. You have to remember, even the best company in the world is a bad investment if you overpay for it. So, how do we figure out if we're getting a good deal?
Well, to figure this out, we can use a fantastic tool called the PEG ratio. Think of it as an upgrade to the standard PE ratio. It's smarter because it doesn't just look at the price relative to the earnings, it looks at the price relative to earnings and the company's growth rate. It adds that critical context.
Now, a PEG ratio over 2 is a warning sign that the stock might be overvalued. But a PEG ratio between 0 and 1, that's the sweet spot. That suggests the stock's price might not have fully caught up to its earnings growth yet, which could mean it's undervalued. This is how we find the right company at the right price.
So, we've covered the logic behind our 3 big filters: quality, safety, and value. Now for the fun part. How do we apply all of this to thousands of stocks without spending the next 6 months doing it by hand? Well, we build an automated screener.
And this is where the magic really happens. This example of a screener query might look a little complex, but it shows you the incredible power of automation. You can take all the rules we've just talked about, ROE, debt to equity, the PEG ratio, and combine them all into a single search. The screener then zips through thousands of stocks in seconds to find the very few that meet all of your conditions.
So let's just do a quick recap of the core rules for our automated search. We want debt to equity under 1 for safety and a PEG ratio under 1 for value. We want a high return on equity, ideally over 15%, but we'll set our baseline screen at 10%. We also demand a low pledge percentage, a price to book value under 5 to make sure we're not overpaying for assets, and an interest coverage ratio over 3, which just confirms the company can easily pay the interest on its debts.
And this is maybe the most important takeaway of all. The list your screener spits out is not a buy list, it's a start researching list. It is your high potential watch list. You've used automation to find the needles in the haystack, and now the real deep dive, the fun part, can finally begin. This whole systematic process gets you, let's say, 90% of the way there. It gives you an amazing watch list of fundamentally strong companies that seem to be available at a fair price. But the final question is, what's in that last 10%? What's the final human check that separates a good company from a true multi-bagger?